of three basic parts. Okay. The first part, these are just the strategy that I use. It is market structure, liquidity, and point of interest. So let's start with the market structure. Coming. Okay. Now, market structure is basically the market behavior. Okay, the market condition, the way the market moves. Okay. So market structure is the behavior or the condition of the market, or basically the order flow of the market, the way the market move from point A to point B, right? And then we have two types of market movement. We have the trending market, and then we have the consolidating market. Then inside the trending market, we have uptrend and downtrend. So there are two types of market movement. Which is the trending market and consolidating or ranging market. And then we have uptrend. For trending market, we have uptrend coming. Uptrend market and downtrend market. Now, how to identify if the market is in an uptrend or a downtrend or a consolidating market? If market is in an uptrend, market create higher highs and higher low, higher highs, higher low. This is how we know that price is in an uptrend. Okay, so uptrend. And then if price is in a downtrend, market creates lower highs and lower low, lower highs and lower low, lower highs and lower low. These are the characteristics of a downtrend market. And then if price is in a consolidating market or a ranging market, it's more like the market is not really moving from one point. The market is not really moving in a straight line. Okay, it's not moving in an uptrend or a downtrend. It's just consolidating, moving from point A to point B. This is how to identify a consolidating or ranging market. Consolidation. Now, in trading the market structure aspect of the strategy, there are two things you need to look out for, which means in trading the market structure of the strategy. Now, I said the strategy are three different parts: market structure, liquidity, and point of interest. Now, in the area of the market structure, I look out for two things. Okay, let me do it like this. I'm coming. For market structure, we look out for two things. Okay. For market structure, I look out for two things. The first one is market structure shift, which is MSS. While the second one is break of structure. BOS. So let's start with the market structure. What does market structure means? Okay. Market structure is basically an indication that tells us that price has changed from the previous direction to the opposite direction. Okay, market structure shift. Market structure shift. This is an indication in the market telling us that market has changed from one direction to the other. So let me use this uptrend for an example. The market is in an uptrend, creating higher highs and higher low, right? But then if price, instead of price creating another higher high, but then price was unable to do that, and then the market actually broke past this previous low. This is now a market structure shift, which means if you are looking for a buy position before, since price broke past its previous low, you will now be looking for a sell. Okay, so this is what it means for price to break, for price to create a market structure shift. The same goes for the buying market. If the same goes for the selling market. If you are in a downtrend and then price actually traded above the previous high, this signal a market structure shift. So if you're looking for a buy position, a sell position before, you will now be looking forward for a buy position. So let me show you an example of the market structure shift in the chart. Okay. From this left hand side, we can say that price is in a downtrend, creating higher highs, higher lows, higher highs and higher lows. So we just have this spike here. I'm coming. From here, we can see that price is in a downtrend, creating lower highs and lower low, lower highs and lower low, lower highs, lower low, lower highs and lower low. But instead of price to create another lower low, market was unable to do that. Instead, price traded above this previous high. Price traded above this previous high, signaling a market structure shift. So this is now a market structure shift, MSS, which means if you are taking buys, if you are taking sales before, you will now be looking for a buy position. That is basically what it means for a market structure shift. Now for the break of structure aspect of it, for break of structure, BOS, markets break past a key level, for an example, e.g. support or a resistance level, while still maintaining its correct direction. So let's say this is a support level, right? Then we have price creating higher highs and higher low, 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 and then price does something like this, breaking above this this resistance level, right? So this is now a break of structure because the market break past a resistance level while still in its current direction, which is in an uptrend. This is now a break of structure. The same goes if price was in a downtrend. We have a support level here. Then we have price creating lower highs and lower low, lower highs and lower low, lower highs and lower low. If price break past this support level, this is now a break of structure. So that's basically the difference between a break of structure. Let me increase this text. That's the difference between a break of structure and a market structure shift. Let me show you in the chart. Okay. So this is a resistance level, right? This was the resistance level in the chart. So after market gave us this market structure shift, which means now that price is in an uptrend, when price was creating higher highs and higher low, higher highs and higher low, higher highs and higher low, price break past this support level, break past this resistance level, price break past this resistance level. This is now a break of structure. This is now a break of structure. Okay. So I've explained the market structure part of it. Now it's the liquidity part of the strategy, because I said the strategy consists of three major parts. We have the market structure, the liquidity, and the point of interest. So I've talked about the market structure. I've talked about so it is time for me to talk about the liquidity part of it. Now for liquidity, I look out for my liquidity. I use inducement as my liquidity. Let me put it here. For the liquidity part of it, liquidity part of it. The liquidity part, I look out for inducement. Inducement. Now, what is an inducement? An inducement is the first valid pullback after a market structure shift or a break of structure. So inducement, which can also be represented as IDN, is the first valid pullback after a market structure shift or a break of structure, which is BOS. Let me come here too. So since we have a market structure shift here, right? Now the first pullback after this market structure shift, this first pullback is now your inducement. You get? And now for the inducement to be valid, the market needs to create another BOS below the previous high, below the previous low. In this case, this is what I mean. In order for it to be valid, market need to trade below this low, which means giving you a break of structure after the market structure shift. Okay, in order for it to be valid, it can just the market might not trade below it that much, but it's either 50% of it, so which means it can do something like this in order for it to be valid, or after price creates this inducement, it can be equal to the previous low in order for it to be valid, or it can trade below it in order for it to be valid. But it has to be very, very close, let's say 50% of this previous low, in order for it to be a valid inducement. Okay, but in most cases it has to create another break of structure after this market structure shift. I'm talking about the case of the market structure shift now. It has to trade below this previous low. So here you now have your inducement. It's IDN. This one is for the selling markets. This was for the uptrend changing to downtrend. And then from downtrend changing to uptrend, you have your market structure shift here. And then the first pullback, which is the inducement, if price is going back up, in order for it to be valid, the first pullback is the inducement, but in order for it to be valid, price has to trade above this previous high before coming back. Okay, price has to trade above this previous high before you can mark this place as your inducement. Now, inducement is a trap set by retail traders, set by institutional traders. Sorry, not retail traders. This trap is to induce traders thinking that market is going to buy from here. So they will drop in early and the price will take their stop loss before actually moving in their direction. So inducement is a trap. Inducement is not the area you are looking forward to buy or sell from. So take note of that. I think I should put it down here. For an inducement to be valid, it has to create another break of structure. It has to create a break of structure, or cover at least 50% of the first of the recent of the previous point. Previous. So let me show you an example of a valid inducement. Okay, coming. Let me show you in the chart. Okay. Now after the market structure shift, the first pullback, So I know the question that you want to ask already, if you are watching this video, is like, it would be, why did I mark this one as my inducement? Why did I mark this one? Because this is not the first pullback. Now this is the first pullback of the market. After this market structure shift, this one here is the first pullback, right? First pullback. And then in order for it to be valid, I said price need to create another break of structure or cover 50% of the first point. So this is your break of structure. Yeah, now, right? But then this one here, this one is correct as your inducement because this is the first pullback. Okay. But when this one is coming back down, this one actually came down lower than this one, and it still did not tap my point of interest. Okay, it came back down and still did not tap my point of interest. So this one is valid as your inducement, this one is valid as your inducement. But the most important thing is that the first pullback here is your inducement, and then in order for it to be valid, it created another break of structure. That is the most important thing you should take note of. Okay. Now I've talked about the liquidity part. I'm coming. I've talked about the market structure part. I've talked about the liquidity part. Now it's time for me to talk about the points of interest. Now for points of interest, I look out for two things. I'll put it here. Points of interest, which is POI. Point of interest. POI. For point of interest, I look out for two things. The first one is your order block. Let me first of all talk about the order block. Now, an order block is a level in the market where there are large pending orders, like the institution and banks and big traders, not just retail traders like us who use $100, $50, $100,000 to trade. I mean, people who actually, the market makers. These are levels that they set their pending orders to either buy from or sell from. That is what an order block is. Okay. So an order block, we have two types of order block. We have the bullish order block, and then we have the bearish order block. So the bullish order block is, you have a bearish candle here. I'm coming. Okay. You have a bearish candle here. You have one candle here, and then this candle engulfs it. I'm coming. Hold on. Let me move this one here. So here you have a bullish candle regardless of the color of your chart, just in order for you to get it simple, it's just that an order block is the opposite candle. Okay, another block is basically the opposite candle. So regardless of the color of your chart, so this one is a bullish order block because you have a bullish candle and then a bearish candle, right? Now, if you want to mark the candle, you mark it from the demarcation, this point coming like this. You mark it from this point, and then you are looking forward to sell the market, right? And then for a bullish one, green candle, then you have this. Then you have this candle. So if you are looking forward to buy, you buy it from here. Now, in the rich chart, the candlestick is not always like this because there might be a scenario whereby you have a candle wick. Now, if the wick of the candle, if the wick of the candle is longer than the body, okay, let's say this one, longer than the body, then the body of the candle is actually short. The body of the candle, let's say like this, like this. Now you mark it from the body of the candle. You mark it from the body, which means you mark your entry from the body. Put your stop loss a little bit above it because of spread, and then you target and you take profits. Okay, so your entry will be from the body of the candle, right? If the wick is longer than the body, but then in a scenario whereby the wick is actually short, the wick is shorter, and then the body is actually bigger than the wick, you mark it from the body of the, you mark it from the wick instead of the body. You mark it from the wick to cover the body. So something like this. So this is one part of the point of interest. Now for the second part of the point of interest is the breaker block. Okay, so I said for point of interest, I look out for two things. We have the order block and we have the breaker block. Now, a breaker block is basically a fade order block. I'm going to show you in the chart. But before that, let me give you an example of an order block. Breaker block. Breaker block. Breaker block is a fade order block. Okay. So this is an example of an order block. This is an example of an order block. Example of a bullish order block. This is an example of a bearish order block. You use bearish order block to buy, while you use bullish order block to sell. Okay. So it is very okay for you to take your entry directly from this body of this candle. Yeah, to take your entry from the body of this candle. So that's an example of an order block. I'm coming if I can show you another example. I'm coming. So this is another example of another block. So you see that this other block actually have a small wick. So you mark it from the wick of the candle to cover the body of this candle. The wick of the candle to cover the body here. And then for the breaker block aspect of things, I'm coming. Breaker block. Now I say a breaker block is a fade order block, right? So let's say price is an uptrend, right? Price is an uptrend. And then there's actually a breaker block here. Coming. There's actually an order block at this particular level. Another block at this particular level. That is supposed to push price back up, right? But then if the market trade below this order block without respecting it at all, this order block is now a fade order block. In other case, this order block is now a breaker block that will act as a support or a resistance to push the market back down. So that's basically what a breaker block is. Come on, let me look for it in the chart. Okay. Okay, this is it. Okay. You can clearly see that the price is in a downtrend at this particular, this time frame. The price was pulling back down, right? Coming down. Now, since the market is going back up, the price is supposed to respect this order block and push it back down, right? But instead, market traded past this order block without respecting it at all. Now, if price is coming back towards this order block, market will use this order block as a support level. In other case, this order block is now a breaker block because it was a fade order block and it will now push the market back up. Let me look for the before of that particular trade. Is it this one? I'm coming, not sure. I'm coming, let me enter the trade again. Let me see which trade is that. Okay. I think it should be here. Okay, this is it. This is the before of the trade. So you see this breaker block here. You have your inducement, and then This is the after of the trade. So that is basically the theory part of the trading strategy. You have your market structure part, which means the market structure is the MSS or break of structure. Now I've shown you the one for market structure shift. Let me give you an example of a break of structure aspect of it. Come. Okay, this is an example of a break of structure aspect of it. Now, when we already know that price is in an uptrend because markets creating this, higher highs and higher low, higher highs and higher low, right? But then this is a resistance level in the market. This is a resistance level in the market, right? Now, price traded above this resistance level. Now, this is now a break of structure, not a market structure shift. A break of structure, because a break of structure is when price trade above or I'm coming. So break of structure is when price is currently in its correct direction, but then it will break a key level like a support or a resistance level. Let me go back to the stitching. Now once you open your chart, you want to analyze the market. Once you open your chart, the first thing you look out for is the market structure. Where has price gotten to and where is price currently coming from. Okay, now for the market structure shift, you look out for your MSS or BOS. So coming. So for the market structure part of it, this MSS is a market structure aspect of it, aspect of the strategy. Market structure. Market structure. And then for the liquidity part of it, the inducement is your liquidity. Inducement is your liquidity. Liquidity, which is your inducement. Liquidity. And then for the point of interest part of it, order block or breaker block is your point of interest part of the strategy. Here is your point, POI, in this case an order block. Now another rule there's a very vital rule you need to pay attention to when picking your point of interest. There are 4 rules you need to follow when picking your point of interest. 4 rules of picking a point of interest. The first one is it has to trigger market structure shift or break of structure. Second one is it has to have a liquidity protecting it. In this case, an inducement. Pay attention to that. Protecting it. IDM. The third one is it needs to be unmitigated. Fourth one is it has to be the POI closest to the inducement. Let me explain this unmitigated and the one closest to the inducement. Let me explain it. Now this order block here, this order block, this order block here. First, I want to answer this question here. The rule. Let's see if this order block actually match this rule of picking a point of interest. We say first it has to trigger a market structure shift or a break of structure. So coming, I don't know what's wrong with network. Okay. See. So we first of all answer the first question. It has to trigger a market structure shift or break of structure. Okay, let's see if this POI actually triggered a market structure shift. Now, price was in a downtrend, right? How did we know that price was in a downtrend? Because market was creating these lower highs and lower low, lower highs and lower low, right? But then market pushing back up, passing this previous high, tells us that market has actually changed trend from a downtrend to an uptrending market. So this first one, we have the correct mark here. The answer is yes. This POI actually triggered a market structure shift. In this case, a market structure shift. There are some cases where it will trigger a break of structure. So pay attention to that. I will still give you the one where it trigger a break of structure. I will give you that example. Second one is it has to have a liquidity protecting it. In this case, an inducement. And I already talked about what inducement is. You can go back to the video and watch that particular clip on how to verify that this is a valid inducement. So the first pullback here, we have the inducement. Second, third, it needs to be unmitigated. Now, when it comes to mitigation, it means that this inducement, after the market structure shift, this inducement did not actually tap this order block. In this case, an order block did not tap this order block before pushing back up. So it means that this order block is unmitigated. You get no candlestick has tapped this order block. And then the last one, it has to be the POI closest to the inducement. Need to pay attention to that. Closest to the inducement. Now you have this order block here. This order block triggered a market structure shift. This order block have inducement protecting it, which means this order block has liquidity protecting it, which means an inducement. This order block is unmitigated. Now this order block here, this candlestick is the one closest to this inducement. I'm coming. So you see that I mark my inducement here, right? I mark my inducement here. Now this order block is one closest to it. That's the reason why this order block is a valid point of interest. So let me show you another example. Let me show an example of a breakout structure. Now this is an example of a break of structure, right? Market break structure, and then this POI here, which means the order block. Another thing you need to take note of is the inducement can be in multiple candle. It does not have to be one single candle. It can be in one single candle. It can be in multiple candle. After this order block, after this break of structure, the first pullback here, which is this single line you are seeing here, is the inducement. The difference is just in the time frame. And secondly, there's no time frame that is perfect for analysis. Any time frame that enables you to see it clearly, you can analyze it for there. Structure is structure. It's just that if you are taking your POI, let it be, if you are taking a buy, for example, let it be in a level, in an area where in the higher time frame buy is supposed to happen from there. If you are taking a sell, let that sell candle, that sell order block or breaker block be in a position in the higher time frame where buy or sell is supposed to happen from there. So if I go down to 15 minutes time frame, coming on, go to 15 minutes time frame. So in the 15 minutes time frame, you can see that we have multiple candles here, and this pullback is just one particular candle. But in 30 minutes time frame is just one particular candle, one candlestick. So you can see that the time frame does not really matter. Structure is structure. As long as it's visible in the, as long as the structure is complete. Okay, so you can use any time frame. I use any time frame for my analysis. I can use 2 hour, 3 hour, 30 minutes, 5 minutes. But if you are picking your point of interest, let it be in line with the higher time frame. Okay. Okay, let me show you another example of market structure. Another example of the strategy. Okay, this was a trade I took. I took this trade and I have this okay. Now price is in a downtrend, right? Price is in a downtrend. The market is obviously priced in a downtrend because we're having lower highs and lower low. And then price actually tapped into a 4-hour support level. Now when price is in this 4-hour support level, I'm not just going to drop in. I need to see my strategy pattern, which means the market structure, the liquidity, and the point of interest. Now if I go down to the 30 minutes time frame, that is what I will be looking for. Okay, that is what I will be looking for. So you have your, after price taps into this 4-hour level, price taps into this 4-hour level, right? Coming. This is the previous high of the market. This point here is the previous high of the market. You see the reason why I said the time frame does not really matter, because if I go down to 5 minutes time frame, you are going to see it clearly. But in 30 minutes time frame, it's just candle. But this is the previous high of the market. So price passing this high, you have a market structure shift, right? Now, after that market structure shift, the first pullback is your inducement. Then I said market, we need to create another break of structure. Market, we need to create a break of structure, which means price passing this resistance level now is a break of structure. This inducement is, this order block here is unmitigated. This order block is the one closest to the inducement. This order block has triggered a market structure shift. This order block has a liquidity protecting it. So you see that when I picked the order block, I followed the 4 rules of picking the order block. In this second entry is basically the same thing, but instead of market structure shift, because price is already in an uptrend, instead of market structure shift, we have a break of structure. Come on, let me go down to 15 minutes time frame. So we have a break of structure here. The first pullback, which is this guy here, the inducement, right? And the market actually traded up again close to this previous high that caused the inducement before coming back down to pick this unmitigated order block and push it back up. So let me show you the before of that particular trade. Let me show you before. Let me show you here. So here's the before of the trade. So you have your unmitigated order block, your inducement, market structure shift, market creating a break of structure. After the market structure shift, there's a break of structure. Okay. That is basically the strategy that I use in taking on my trades. So you watch the video, you come back, you back test it, you go to your chart. All you just need to know is just follow the simple rules. I'm coming, let me load this now. All you need to do is follow the simple rules. So as soon as you open your chart, first you need to look out for market structure. Market structure. Now the market structure aspect of it, you have your market structure shift, then you have a break of structure. After getting your market structure shift or your break of structure, you move to the next part, which means the liquidity part. Your liquidity is your inducement. How do you know that this is a valid inducement? Is what I've already given here. The first pullback after after a market structure shift or a break of structure. Computer is actually then how do you know that this inducement is valid? Is that it has to create a break of structure after the market structure shift, or in the case of break of structure, the price has to cover 50% of the previous point. In this case, you have your inducement. This is the previous point, right? Market need to break structure before coming back to your point of interest and moving up. You get, or you can also have it like this. This is your inducement. Market create equal highs with this guy before coming back to this point of interest. It can be a breaker block or an order block before moving back up. Or you can also have it, market do something like this, 50% of it, come back down, tap in, then move back up. So you don't even need to take time to spend with the chart. You already know what you are looking for. So as soon as you enter the chart, you look for those things. You look for those things. You watch, you backtest, you come back again, you backtest it. And then one thing you need to take note of also, after knowing all this and backtesting it, is that markets move from external high to external low. So this is what I mean. Let's say you have this high, price trade creates higher highs and higher low, higher highs, you have your inducement, market structure shift, market tapped into your, and then eventually market took out this high coming. So you have your market structure shift here. You have your BOS. You have your BOS. Market structure shift. You have your inducement. market structure shift. Then you have your order block or breakout block. You place for a buy position, buy position. A buy position, right? Place for a buy position. Now this is the structure of the market, right? So this is the external high of the market. External high of the market in the higher time frame. Okay. For example, this also happened in the lower time frame. If price take out the external high, this is just the simple way to explain it. If price take out the external high in the 4-hour time frame, it's going to move to external low in the 4-hour time frame. So if price come here and the market give you a market structure shift, you have a market structure shift, you have your inducement, and then you took a sell position. Now price is going to find its way to the external low of that same time frame. Market will not just come directly, but direction of the market has changed from buy to sell, and the sell is to come clear out the external low. So if price take out the liquidity in the buy side, is going to move to the liquidity in the sell side, because liquidity is what move the market. So let me use Nasdaq for let me use this Nasdaq for example. So you see that price was in an uptrend, market was in an uptrend, creating higher highs and higher low, higher highs and higher low. Now if price is coming down, price will need to clear out the liquidity, all the liquidity in this buy side liquidity. Price will need to clear everything out before then moving back up. You can see the pattern that which the market is coming down, lower highs and lower low, lower highs and lower low, lower highs and lower low. So after price clear out this liquidity, now price will now start going back up. So let me use euro, let me use US oil for example. US oil for example. Okay, US oil. US oil for example. Now you see that market is in an uptrend, right? Price was creating higher highs and higher low, higher highs and higher low. But then when price actually came to this 4-hour resistance level, this 4-hour level, if I go down to 30 minutes time frame now, this one as example, down to 15 minutes time frame itself, so you see it clearly. This was the lowest point of the market. Market passing this lowest point tells us that price has changed from a buying market to a selling market, market structure shift, right? Now to confirm this market structure shift, market broke a support level, making it a break of structure. Now after this break of structure, the first pullback is your inducement. Market tapped into this inducement, and then price started dropping. I will show you the before of the trade. For the second position is still the same thing, but second position here is breakout block. You have this breakout block unmitigated. The first pullback is your inducement, Market actually passing this zone again. Break of structure, created a break of structure. The price came to tap in. Now, since price is rejecting from a 4-hour level, market will need to clear out the liquidity in this buy side and move down to another 4-hour order block or breaker block before you start buying again. So if you look at all these levels here, there are no inducements. There are no inducements in all these levels. There are no inducements in all these levels. All the point of interest here has been mitigated. Get. So the unmitigated point of interest you have is this order block, this first pullback. So if you are looking forward to buy the market, let's say after this sale, you are looking forward to buy from here. You are looking forward to buy from here and market is going to hit your stop loss. The reason is because one, price has taken out an external high. Is this high here? Price has taken out an external high. So it will need to go down to external low before start buying back up. Let me go to Euro card position. Let me show you another example on Euro card. So you see that after price took out this high, if you are placing any buy position around this level, market is going to hit your stop loss. The reason is because in the higher time frame, market has taken out the external high. So market will need to move to an external low. How do you know external high and external low? It's very simple. This is the highest point. This is the lowest point, right? So if price take out this highest point, market is going to come to take out this lowest point. In the higher time frame, that is how you know external high and external low. So the strategy is very, very simple. You just need to look out for three things. Three things is what you're looking out for. Okay, this analysis I did now. This analysis I did. Price is already in an uptrend, right? But then price broke past this resistance level, giving me a break of structure, right? A break of structure. Now the break of structure, after this break of structure, after this break of structure, we have an order block here. We have another block here. Let me go down to 15 minutes time frame. An order block here, unmitigated, which means this point of interest now has now triggered a break of structure. After this order block, the first pullback, which is this week, is now our inducement. And then this inducement, we know that this inducement is valid because it gave us a break of structure. So if price is coming back down now, I'll be looking forward to buy the market from here back to the upside. So it is as simple as that. You just need to follow all the rules.